G'day and welcome to another Motley Fool YouTube Live. I'm Scott Phillips from the Motley Fool. I'm our Chief Investment Officer here in Australia. Thank you for spending a little bit of your Friday early afternoon if you're on the Eastern Seaboard, earlier afternoon in the middle, and late morning in the West. Thanks for spending an hour or so with me. If we get to that hour, look, I can talk. So let's hope we're going to have a good time together. I've got so much stuff to get through, but I really want to hear from you. So this is a Q&A, right? I will give you a market update. I'll tell you what I'm thinking, tell you how I'm investing, what I'm kind of considering. That's what we do at the beginning. And then I want to answer your questions, as many as we can get through anyway. That's the intent. That's the aim. So we will do that over the next hour or so. I assume this thing's on. It looks like it's recording. It looks like everything's going okay. So if you are hearing me and seeing me, just let me know in the comments. That'd be lovely. By the way, the comment section is there and it's available to you. I've already got one comment through from Dan saying cool. So thanks, Dan. Not sure about cool, but we'll do what we can. Yeah, thanks for joining. Thanks for being part of this Motley Fool YouTube Live. We got to start with Musk and Trump, don't we? I don't want to spend too much time on US politics, frankly. It's kind of boring for me. It's boring for you. Thanks for everyone saying g'day. Good to hear. Thanks, David. Thanks, T. Oh, I've got him with glasses. T-Ball. Now, I've said lots of times when I do these, my main computer is over there. So I'm going to look over there. That's where I'm showing myself. I'll bring it up on here in front of me, so I'm looking down rather than across. That's what I'm doing. All right. So Trump, Musk, man. Didn't that blow up overnight? We saw the Tesla share price fall 14.3%. This was $1 billion company before that, right? So the best part of what I call 140 billion in round numbers, US, by the way, and another half again. Is that 200 billion Australian dollars? It's pretty close to that. Fell because of the spat between Donald Trump and Elon Musk. It's getting ugly. It's getting silly. It's a soap opera, except it's not really, because it's between the leader of the free world and the world's richest man. This is not a backyard stoush, right? These are big, big, big things. To the extent that Donald Trump is cancelling tax credits for electric vehicles, and Elon Musk has threatened to then cancel the SpaceX program. He runs SpaceX, his private space business that supplies a lot of rocket astronauts to and from the space station, get the satellites into orbit, all that kind of stuff for NASA. So it gets big, it gets silly, it gets a bit whatever at some point in time. Look, what does it matter? I guess it matters on a couple of reasons. The first is there's ongoing uncertainty, ongoing kind of volatility, call it what you want. Trump is nothing if not volatile. And again, I don't even say that from a pejorative perspective. I will happily say, I've said to you before, I don't particularly think he's fit for the office, and I think tariffs are a terrible idea. So I'll put my cards on the table. Happy to do that. I hope it doesn't cloud my judgment on other things. I'm not a big Musk fan either, by the way. I think he's right about the budget. He's done a great job with Tesla and SpaceX. Doesn't mean I like everything he says and does, and that's kind of the point, right? We shouldn't be cheerleading teams. We should be taking each individual issue on its merit, saying, is that person right? This time around, Musk is right. Trump is adding $3 trillion to the US debt, apparently, according to the new so-called one big, beautiful bill that he's trying to roll out. The US is already massive, massive debt issues. It's just silly. And so in this case, Musk's right. Adding more to the debt, lots of, as you say, pork barreling, as we like to say, in those bills apparently, or that bill, it's a singular one, as we know. That's a big deal. So it matters, right? It matters for the health and the strength of the US economy. It matters for the way that the US economy impacts the rest of the world. And so, yeah, it kind of is a big deal. And of course, then what Donald Trump does or doesn't do as a result of this, is he emboldened? Is he, there's a bit of you push someone into a corner, what do? You make them fight harder. Is that good for us? Is that good for the country? Is that good for America or for Australia? We don't yet know. But the market fell overnight, probably less than I thought it would, actually, about 0.5%. Not that I care or make predictions about single-day movements, but it is what it is. Why? Because people are concerned about the response of Donald Trump, the policy decisions he may or may not take, what it says about who's calling the shots in the White House. And I think some degree people listening to Musk and saying, hey, this guy seems to be roughly right. And I think he is. Even got Republicans coming out and basically saying, we won't vote for the bill either because of the debt situation it leaves the country in. So, yeah. The other thing this week from the US was the tariffs. They've doubled the steel and aluminium tariffs from 25 to 50%. That's not pretty. It's going to hurt our steel makers and aluminium makers. It's going to hurt others around the world. And the US simply doesn't have the capacity to manufacture enough steel and aluminium to replace that which is being tariffed. What does that mean? It means American consumers and businesses are going to pay a whole lot more money. They are paying more money for their things. That pushes up prices. If that pushes up prices, causes inflation, and it's potentially going to slow the US economy, maybe even export some of that inflation around the world. So that's why it's concerning. It's just dumb policy to start with. I've said that before. I won't labor it. I did a YouTube live a couple of months ago. Feel free to go back and look at that. I had a bit of a rant. But essentially, it makes people's standard of living worse, even Americans, because they've got less money to spend on fewer things. That means you buy less stuff. You buy less stuff, you have a lower standard of living. It's the way it works. Is it good long-term for American industry? Maybe. But if you've got to keep a tariff in place, you're always going to charge American consumers more money for those things. If they've got more money to spend on product X, you can't spend more money on product Y, lowers your standard of living. And by the way, product Y was sold by an American somewhere, either locally produced or imported. So yeah, it's just bad policy. If you want to look after your own countrymen and women, I get it. There's better ways to do it than tariffs. So I'll leave that one there. I've said this plenty of times before, but that's where we find ourselves. I'm going to throw the glasses back on and have a quick look at the comments. Lithium producers, excellent. Sulfates and Brickworks. We'll get to that in a minute. Awesome. David, you agree. Thank you. US tariffs, about time Australia push back. Yeah, it's hard, Richo. Honestly, I think I may have talked this last time. If I did, I apologize for going over old ground. We've got two issues, right? Or two options. One is you push back. The other is you just kind of go around it. Now, at the moment, we've got trade representatives in Europe trying to do a deal with the EU. I think that's a really, really good idea. The part of me that wants to kind of say, hey, don't tread on me, you can't do that to me. I'm gonna fight back. Wants to push back on that sort of stuff. And I hear you, Richo, for sure. The other side, though, unfortunately, is because of the US's size, military, yes, but even more economically, they're 15 times our size as a population, probably something like that in terms of GDP, I would suggest. We'll get to GDP in a second too. So the challenge is, the analogy I've used is the year 6 kid taking the kindergarten kid's lunch money. Now, you say to the kindergarten kid, oh, we should punch back. And then what do? Well, you punch him, it hurts a little bit, but probably not much, just annoys him, and he hits you back harder. And so there is something which I know it feels kind of morally not fair. It's just not fair. They shouldn't be able to do that to us. We should be able to do something back. Sometimes you just can't. Sometimes you're the kindy kid. And we are the kindy kid in this particular fight. Doesn't mean we should necessarily give up everything, but fighting back doesn't solve much. They've got more leverage than we've got. So yeah, if it's tit for tat, they've got bigger tats than we've got. That's the reality, right? So I avoided what I was going to say then, by the way, for those who are paying attention. That's the big challenge, right? And so could we push back on AUKUS? Yeah, but what does it do? It annoys Donald Trump. Maybe save us some money, sure, but then he says, well, okay, you can guys get stuff. I'll double your tariff. And then where are we? We can't win that. We just have the ammunition to win that particular war, the trade war. So I would go around it. I would cop it. Not necessarily sweet, but just accept you have to do what you have to do. By all means, again, look for other trade relationships, find other ways of doing it, both imports and exports. But yeah, I don't think trying to fight back when you're massively, massively under strength is a good idea. But again, I absolutely get where you're coming from, Rich. I totally agree. Yeah, just a bad deal altogether, probably. And we get rid of it for that reason. I don't know whether the Yanks really care about it. Honestly, I'm not sure. Change of administration here and there. Do they care? I don't know. Is it good for our defense? Possibly. The spending on the subs aside, is it good to have good alliances with the UK and the US? Probably. But I'm no defense expert, no geopolitics expert, so I'll leave that one alone. An opportunity, defense spending, rare earth deals with the US. Yeah, maybe it is. And look, Trump's nothing if not a transactionalist. Is that a word? It is now. So maybe that works. Maybe that works. All right, let's move on from. By the way, hold me accountable on some of the earlier questions because I'm going to try and go through some bigger sort of market stuff, and then I'll go to the questions towards the end. But do leave them there because if you put them in, I'll probably do it in roughly chronological order. So if you want your question answered, whack it in early so I can get to it. Last time we ran out of time, I think I went a couple of minutes over and rushed through a whole lot of questions at the end. I talked too fast too. I know that. I'm sorry about that. I'll slow down. I slow down for about a minute, then I forget. So let me try that. Okay, what else on my docket? So let's do the economic stuff and then get to some of the market stuff and then some of the company stuff. We'll probably do it in that order. GDP was out this week. Ordinary, really, really soft. 0.2% was the growth for the quarter. 1.3% for the year. Now that's better than annualizing just the last quarter, which kind of feels good, except by definition, the stronger growth was in the past before the last quarter, right? Because if the last quarter was 0.2 and the total is 1.3, don't have to be a mathematician to work out that the 3 quarters before that were obviously larger. So we are decelerating. Still positive. That's the win. But coming down, and 1.3 is bad enough. 0.2 in the quarter, or what would be 0.8 if you annualized it. You shouldn't just multiply it by 4, but if you did, with 0.8, I mean, the economy is big and lumbering, and it's the old take 15 miles to turn an oil tanker type stuff. If we are decelerating, trying to get some energy in it and momentum back into it can be tough and take a while. By the way, Musk tweeted overnight that he reckons that the US in for a recession in the second half of this year. I don't think he's necessarily wrong. So add that to our slowing growth here. We've got some headwinds. let's be really honest. Yeah, rates are coming down, partly, by the way, because they were not too high, but they were higher than needed to be because inflation's coming down. But the other part of it, the RBA going, well, we've got to deal with inflation. On the other hand, I've got a slowing economy. We've got to try and do something. So they are dropping rates. That is, to some degree, going to help. They again talked about doing 1/4 or 0.5%. That may tell us that next time they meet, the other quarter to get to a half might be on the agenda. I don't do predictions, as you probably know by now, because no one knows, right? What's the point? If you don't know, why bother guessing? If you guess right, it's still a guess. If you guess wrong, you say, well, it's just a guess anyway, who cares? And the whole thing's a bit of a charade. So I don't do predictions, but if you're setting a market, I try and think probabilistically as an investor. If you're framing a market, I suspect 1/4 point early July is probably favourite, possibly by quite a distance, and maybe even odds-on favourite, but we'll have to wait and see. The GDP numbers aren't great. The best news is that despite that, by the way, retail sales were negative. We got those numbers out last week. So was private capital expenditure. That's a jargony way of saying the stuff that businesses and people are spending on assets that continue to deliver value over time. So not just making up one thing and then selling the thing, but the machine that makes the thing, right? The coffee tables at the cafe, or the folding machine at the steelworks, that kind of stuff. That's where the money is being spent on what they call capital expenditure. It's a capital good rather than a consumption good. Capital obviously hangs around. You probably know that, but just so you don't, if you don't, you do now. They were both down. So that also, and by the way, they were last week's numbers, I think, for the previous month. GDP was for the quarter. So again, if you're kind of looking through this thinking, well, hang on, we had a tough quarter. The data after that was worse again, negative. I'm not a doom and gloom kind of guy. And again, I'm not making predictions, but I will tell you that we're not particularly well placed. And that's not great, but it is what it is. So GDP soft raises the risk of potential recession. Sorry to say that out loud, but certainly slower growth. I was talking about the positive sign. The positive was unemployment. We're still at 4.1%. Given the growth in the population, that is remarkable results. Part of it, by the way, somebody are yelling at the YouTube machine right now. Part of that is government's funded positions, healthcare in particular, NDIS, early childhood, I think probably some there too. So it's not necessarily economically productive. They're not good jobs, don't get me wrong, but it doesn't add to GDP or economic output, right? We should absolutely look after and educate our kids. We should look after those with disability and illness. So I'm not saying we shouldn't do it. I'm just saying the jobs were created by government spending, not by an economy that's growing. And that's just kind of worth pointing out. Now, best part of it, still people got work, right? So I'm not saying it's not worth anything, it's worth something, but we've got to be careful about what we think about that. But 4.1% unemployment, very, very good. Underemployment, I think even fell. Underemployment is those who've got jobs want more hours. That fell last time around. So that was a pretty good outcome. But yeah, GDP is really soft. So we're kind of sailing into troubled waters between the GDP slowdown here, the potential issues out of the US. It's not a great combination. More questions through, heaps more. Thank you. Quickly, anything on what I just said? Can't build enough subs themselves. Okay, I'll leave AUKUS alone. I think we covered that. Linus, Nicole, I'll get to. Domino's, David, I'll try and get to. Remind me to. Yeah, Trump's going to arrive a third of the debt in September. You're exactly right. It's hard to know what's going to happen there. He's putting massive pressure on Jerome Powell to cut rates, right? So we'll see. Aussie GDP, a bit of a worry, as you say. Rich, overtaxed businesses and people lose motivation. I think to some degree, yeah. I mean, by definition, that's true. The hard part is getting the right point, right? If a couple people lose motivation, we raise a lot more revenue. You're still ahead. At the point at which that flips and becomes a net negative to tax receipts, that's a problem. I don't think we're there yet, but every extra tax you add, you get closer to it, right? So it's the right question to raise. Leverage property and stocks. I'll get back to that. Victoria, not real jobs. I mean, they are real jobs, Matthew. I think it's a little unfair, respectfully and kindly. Teaching our kids, that's a real job. Looking after our disabled and ill, that's a real job. Is it a job that adds to economic output? No. And that's an important distinction. I don't think we should suggest they're not real jobs for what it's worth. There is, by the way, a lot of rorting, I'm sure, in NDIS. Doesn't mean we shouldn't look after those people. I've tweeted about this before. The NDIS needs meaningful reform. It actually probably needs to be blown up and replaced. A bit of a tangent. I don't want to go too far down it, but you asked, and that's what we're here for, so I'll talk about it. The structure is awful. You have a three-cornered market. You have the payer, it's the government. You have the provider, so the healthcare professional or affiliated service professional provider, and the client or patient. Now, who's got the incentive in that story, right? The client's got no incentive to say, please charge me less. The service provider's got every incentive to overcharge or over-service. Maybe there's a straight-up rorting. It's hard to know. Because the government over here is saying, well, here's the check. That's all they're doing. Now, they are doing some auditing. It's unfair. They're doing a little bit, and that's important. Excuse me. But yeah, it's a massive, massive issue for the federal budget. We're spending too much money on it. The criteria are too loose. And again, I say that not as a healthcare professional, but as someone who's in the economics of it. Medicaid has scheduled fees. Every story I hear, and again, I know it's anecdote, but enough of them together start to become data. Every service provider charges the maximum scheduled fee because they can. And the client's got no incentive to not use that service. They've got no incentive to shop around. Some will, which is great because they're just doing the right thing by the taxpayer. But if you're already crooked, you're already disabled, and you're not in a position of power to shop around necessarily in those places. So the whole thing's broken. It needs to be fixed. It needs to be fixed massively, quickly. There's probably, I don't know what the number might be, but it's probably tens of billions of dollars on the table, maybe 10, maybe 20, something like that. So thank you for messaging that one. Job loss to AI, David. Man, we'll talk about that. You and I have been chatting on Twitter too. I recognise your name. Thank you, David, for being part of that. Oz economic data and surging ASX. Lynette, here's the thing: it is the ASX is an all-time high, despite all that stuff. So I think. Sorry, you're saying it is surging. Yes, I understood. I misunderstood your point. For two reasons. Great question. If you look at the history of economies, what you see is this up and down wave. Same happens with stock markets. I'll spit that out. You get the same kind of waves. Over time, both go up and to the right. The reality is that a recession is more impactful for the economy writ large than it is for the market, because the market prices shares out to infinity. I'm not going to get to the dollar cost, the discounted cash flow algebra at this point, because this is not a great thing to do on video or audio. It's something you'll do on paper. But effectively, if you say, well, take Woolies, easy example. Woolies share price today should reflect, if it was efficiently priced, it never is exactly, but close enough. Should reflect the profits from today till forever, literally forever, discounted back because there's a time value of money, both inflation and, hey, if I get $1 now, if you say you can have $1 now, $1 in 10 years' time, when do you want the dollar? You want it now. If you say, I'll give you some money, you say, how much do I have to give you to make it worth waiting 10 years? I'm not going to say $1. I'm not going to say $1.05. I might say $2. I might say $5. But that's what investing is. That's what discounted cash. Discounting is basically using the time value and saying, well, how much do you need to wait? So Woolies from now to forever, the share price is their total sales and profits over that period of time. During that period of time, there will be recession. Now, Woolies is probably a bad example. I apologize because it's a pretty non-discretionary. Let's say JB Hi-Fi. In bad years, the customers will walk away. Nick Scali was another example, right? People bought less furniture last year. Why? Because the cost of living hurt. Over time, though, over 10 years, is Nick Scali going to be a bigger or better business? Probably, I suspect. And so the shareholder says, well, there's a recession right now, and it might last for 6 months, but in 10 years, Nick Scali will be a bigger or better business. So I'm not going to discount that value all the way to zero. I'm not saying it's not worth 20 or 30% less all of a sudden, because I'm still getting those future profits. So that's kind of the story. That's the answer. When it comes to the economy, by the way, the economy doesn't fall as much as the stock market usually. If it falls, it might fall 1 or 2%. The problem is that the amplification, the multiplier effect of that through the economy is really serious. 4% unemployment could be 6 or 7 or 8 or 9. Businesses will fold. People go bankrupt. So now that gets better as well. So we've had a recession 30 years ago. We've had a great time since. Was the 90s recession great? No, it was awful. Did we recover and flourish after that? Yes. So again, that bump of yes, it goes up and to the right. I think is that your right? That's my left. So I don't know if it's your right or not. I think it might be. Yeah, because that happens, that's why you don't see the market fall as much usually when there's a confrontation or chance of a recession, because it will fall a bit, by the way. Individual companies will definitely fall. We saw that during the COVID recession. Individual companies did fall and some came back and some didn't. That happens. But that's kind of the answer as to why the market tends to be reasonably positive. They're looking through the next problem. They're looking through the next 6 months saying, well, okay, 2026, 28, 29, 32, 38, we've got better economic circumstances. Companies are making more profits. The economy is larger. That's why if you're an investor and a long-term investor, you should be. Motley co-founder David Gardner says long-term investing should be a tautology. All investing should be long-term. You can afford to ignore it. In fact, I do. Actually, not only do I ignore it, I actively look for those companies that are beaten down. If the market freaks out now about company X, JB Hi-Fi, for example, if sales fall, no, it's all terrible, it's all terrible. If you look at that and go, well, hang on, the price has fallen 10, 15, 20%, but JB Hi-Fi's future is really bright, 22, 32, profit's still going to be really, really good. there's a great opportunity for that. So maybe to your point, I'm actually disappointed it's still surging to some degree. We like getting richer, we like our portfolio is growing. If you're looking to buy shares, you want those opportunities to grab them when they're cheap. Legends of Diggers Camp. I usually input chat. You enjoy my humor. Very funny. Hard to understand. You're talking, but very clever. I think that's a positive. Legend of Diggers Camp. Thank you. I will try and slow down. I said already I talked too fast, so my apologies. Lack of CapEx spending, Matthew. Yes, I agree with that. CapEx spending is one of those very few leading indicators we have in the economy. Confidence is my favorite one, consumer and business confidence, because again, it talks to if you feel confident, you spend because you think the future is going to be bright. So you create the outcome you expect. You think it's going to be good, you spend, so it increases economic activity, so therefore the economy is better, and you go, see, I was right. The reverse is also true. When you say the economy is going to be awful, so I'm not going to spend just in case, what happens? No one spends. Fewer people spend. The economy drops. You say, I told you, I was right. The economy fell. So that's why confidence is a self-fulfilling prophecy. Really, really important. But CapEx is the same, mate. If you're going to make something, as you say, in 3 or 5 or 10 years, or even 3 months, frankly, if you haven't got the machines, if you haven't bought the tables for the cafe, the new coffee machine, again, insert your own preferred industry here, you can't do the stuff. And so you're less likely to produce it. Now, economic activity is not always supply push. It's demand pull as well. But if you're not buying something, someone else doesn't get the sale either, by the way, and that goes through the economy as well. So for 2 reasons, private CapEx being low is not great. Dominoes, I'll get to, Martin. Shining moments in these shenanigans. That's a great phrase. Commodities are ripping. Could give some nice stocks. Okay, interesting. John, is the stock market a good place to be now? So, yes. And I'm going to say that today, tomorrow, the day after, the week after, the year after. The stock market is always a good place to be, in my opinion. Now, how can I say it's always a good place to be? We know in the past there's been crashes. In the future, there'll be crashes. Was the stock market a great place to be the day before the market crashed in March 2020? Yes, absolutely. Did it still crash 38%? Absolutely. Am I mad? No. If you want to take the macro and try and time the market, you're going to get burnt, in my opinion. I can't give you personal advice. What about you personally? Was it John? John? I can tell you what I think in general. Timing the market means you've got to get out at the right time and then get back in at the right time. Easy in hindsight, incredibly difficult at the time. There were some really smart fund managers and investors who in April 2020 said, I will not get back into the market until the pandemic is over. Now, you know, I know, not only have we had the fastest bear market in history, that 38% fall in a month and 4 days, we had the fastest recovery in history. And then the market kept going up. The pandemic wasn't officially over for a couple of years. The amount of money that was lost by avoiding investing during that period of time was massive. So I get the temptation. I get the whole, if I just take the money away, I can't lose it. You're right. Take the money away, you can't gain it either. So what happens next? I mean, even this thing about this year, I've got the numbers in front of me. I might really try do it very. How's this for live? Let's go the All Ords. Let's go year to date, right? Because we know the market hit a high in Valentine's Day. I think, for look at it, 14th of Feb. Well, yeah, it was. I think it was Valentine's Day was the high for the All Ordinaries this year, at 8,825 points. By early April, it was 7,524 points. What's that? 1,300 points on 8. What's that? An 8. Yeah, maybe 13, 14, 15%. So, and then it recovered, by the way, and it's now higher. Oh, no, almost higher than it was back then. We hit a record high. Now, the shenanigans over that period of time, think about the tariff announcements, think about Liberation Day tariffs, think about the increase in the US China tariffs, think about the steel and aluminium tariffs, think about all the stuff that happened. And yet, the market is back where it was. Now, if you sold out before February 14th, you had some sort of perfect insight, then yeah. Again, with perfect insight, I could tell you exactly the day to buy and exactly the day to sell. Before that, if you'd sold out, I don't know, say Trump was going to be terrible, and it was the 13th of January, and you sold out. The market then went up up about 7 or 8% after that, right? And then you say, well, I'm going to sell if the market starts falling, but when do you buy back in? In hindsight, you say, well, of course, at the bottom. But was it going to be the bottom? I remember, was it 20? Oh man, I can't make it up now. I was in this job, and it must have been 2013 or 14. And people were no, it was the was it that? Anyway, I can't remember. Sorry. We had a market a jump in 2016, I think, down 17. And I had people tell me, there's going to be another recession. There's going to be a double dip. It's going to happen again, all that kind of stuff. It didn't happen. And the market went on to new highs. So, yeah, timing the market, I think, is a terrible thing to try to do. Why? Because I don't think it can be done reliably and regularly. And if you miss the gains, remember, the market goes up over time. That's the thing. You're betting against the trajectory of the market. You're saying it's going to go up over time, But I'm going to work out when to get out, out, in. And trying to on a rising market, you're betting against the trend, in my opinion. I don't mean share price trends as in momentum trading and technical analysis. I mean just over time the market goes up, right? So I don't do it. I wouldn't try it. I've never tried it. I would never try it. I'd rather ride the waves, cop some of the lashings when it goes down, but you get the recovery when it comes back. And the market has always gone to new highs. So that's the other thing. You want those new highs? Stay invested is my personal view and my personal advice. But I can't tell you personally what you should do. But the advice I would give anyone who was asking is exactly that. I will come back to some other questions. Treasury, I'll talk about that in a minute. John, we've talked about impacts of AI. Steve, Richard, give me to come back to that if I don't remember. Tesla stock, that's a great question here. I'll come back to stock-specific stuff. I'll probably talk macro-ish for about another 5 minutes, about half past. In the last half an hour doing some Q&A on stocks and just, industry and stuff like that. Oh man, unrealized gains, Matthew. You're letting me off one. The most viewed video on our YouTube channel ever, other than a couple of marketing videos that we've put up there to kind of link from some marketing stuff that we've done, but the kind of general consumption content was a 5-minute video I did about 2 or 3 weeks ago on the unrealized gains. It is a terrible, 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 terrible tax. Not because I'm affected by it, and not because I don't want people with more super to pay more tax. If you have large super, you don't like tax, close your ears. I think we should tax super more. Here's why. If you got $3 million in super, as of 1st of July, it's gonna be the first $2 million, earnings are tax free. From $2 to $3 million at 15%. Now, average that out. And the average tax rate on the earnings for a $3 million super fund, probably something like 6%, maybe? Average tax rate. Now, yes, you've worked your whole life for it. Yes, you've put it aside. Yes, you haven't been able to touch it. I get it. But think about the tax burden today. Everything we're spending, now we can spend less. Don't at me on that one. Everything we're choosing to spend right now has to be funded by taxes. You got a nurse, a farrier, a copper, a factory worker, a taxi driver, an accountant or whatever, paying 20, 25, 30, 35% average tax rates. And you got superannuants paying 6 on $3 million worth of super. It is way too generous. Now, I say that as someone who hopefully someone I'd love to have a massive super balance, right? So if I get taxed more, I'm good with that because I just don't think it's the fair distribution of the tax burden. Again, individuals say, I don't want to pay more tax. I get it. I don't want to pay more tax either. But overall, the burden of tax, the spread, the distribution, if you like, of who's paying what, is just way out of kilter. So in my opinion, they should pay normal tax. That being said, unrealized gains, stupid. Your house goes up 10%, $1 million goes to 1.1 million bucks, $100,000 profit, pay 30% of that in tax. Where from? Maybe you got some rent, maybe you got some other money outside super, maybe you got something else to pay. You haven't realized a single red cent in gains, you got a $30,000 tax bill. Now, I said your house, it's an investment property, blah, 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 using a simple example. Terrible, terrible, terrible tax. Not indexing it, madness. People say, oh, the government's going to index it later. When's the last time you remember a government introducing indexation on any tax, right? And if you're going to do it later, do it now. It's frankly political cowardice to say, oh, we'll let someone else worry about that in years to come. Rubbish. Absolute nonsense. And it's going to be retrospective, apparently. It's going to go back to July 1 this year when it's introduced in August. 3 reasons it's terrible. Hate it, hate it, hate it. Will it have thoughts on change? Valuations will suffer. So here's the thing, Matthew, you might be right. If there's forced selling, because if you've got forced sellers and more desperate sellers than you got desperate buyers, prices can come down a little bit. The thing is, those people are going to do something with the money they get from that. They either spend it in the economy, it's good for economic growth, or they buy other assets outside super. So net, and it's only 85,000 people for now. It doesn't mean it's a good tax, but right now, I don't suspect it's a huge deal on asset prices overall. There might be some dislocation, a bit like GST. There may be some dislocation in the first few months or a year, possibly. So maybe. Do I have enough confidence in that view to do anything about it? No. I mean, if you knew what's going to happen, you might sell everything and buy when everyone's doing fire sales on assets on July 2 or something. But I don't think it's going to be that big a deal. The other thing, by the way, is remember inside super, even the unrealized gains, which is dumb, you're paying less tax than outside super. So it's also, you got to be not careful what you wish for, but if you're someone who's trying to avoid tax and take money out of super, you made it with a higher tax burden outside super than inside super. So just, they've got to be careful with that. I don't suspect it's a huge deal. Still a bad tax, bad on principle, that's enough. But yeah. Drone Shield come back to, should I take a risk on buying gold and silver, Paul? I can't tell you what you should do. They're pretty high, both of those. The problem with trying to trade that sort of stuff is working out when everyone else is giving up that trade. So we saw when the US market fell 9% a couple of months ago. The three of the five top stocks in the ASX were Woolies, Coles, and Endeavour. Right, Endeavour is the business behind Dan Murphy's and BWS. That's so everyone bought them, right? But then what happens? Who's going to buy them after that? Nobody. And when the fear goes away, what happens? Everyone sells their Endeavour and goes back to the other stuff. So you're kind of buying high and selling low potentially. I'm not saying what will happen with gold and silver next. There's quantitative easing or potential money printing, which might support the value of gold, honestly. So I don't have a strong view on it. But I would say be careful of the safe haven trade, because when the tide's all the way in, you can only go one way. So there is a risk that at some point, if you're buying as the safety trade when everyone else has already done that, you may be buying towards the top. When everyone else says, oh, coast is clear, they get out of the safe stuff, allegedly safe stuff, and get other things that may push the price out if they're selling to realize those gains or to get the money out, invest them in something more productive. May not happen, but if it does, that'd be the concern. So just have a think about that. John, yes, exactly. Yeah. Commercial property value goes up, you got no more money to pay it, you're in trouble. Excuse me for a second. Land with an SMSF from Cashman. That's a big question. I haven't been asked that for a while. Oh dear, land. Depends what you do with it. I'm not a fan of owning assets for appreciation that are not producing anything. The value might go up, or it might not, but it's harder to value and harder to kind of recognize. Frankly, in this new rule, if you got more than $3 million, I wouldn't do it because you pay tax on it. There's no income from it. Do I dislike land though? No, I don't. I think it's fine. I prefer productive assets personally. That's why I don't own gold, by the way. I like things that make stuff. A, because they grow. B, because they have a cash output, and C, they're easy to value. It's not perfectly easy to, but easier to value. So would I buy land? No, I think I'd probably want something that, if you had a strong view that was going to go up, was going to go up more than anything else, or you want to diversify, can't hurt. Again, I can't see what we should do personally, but that's just my 2 cents. Says I'll come back to. Oh, wow. It's Richo. US W8 bend forms in the growth tax. Should I consider minimizing exposure to US stocks? I don't think so. Less obviously risk-free than it was, or not risk-free, but it's probably slightly higher risk now than it was, because Trump's unpredictable and he could do anything. He's also not liking foreigners much, kicking out a whole lot of people, not letting people come to study at Harvard, not letting people in certain regions and jurisdictions. I don't think it comes to us. So for what it's worth, half my portfolio roughly is in the US, and I haven't changed anything. I'm not going to. W8 bend form needn't worry you, as far as I'm aware. CBA shares, Mark, great question. I'll come back to that. My house is on investments of luxury. I'm okay with that. Fair enough. Vegas trip. I love that. Have you been, or you're going to Vegas? I'll come back to ETFs. AUD so low against the US. What do you recommend buying US shares? That's a great question. Depends on your time horizon. The AUD feels low against the US dollar, but where does it go up to? And over what period of time, and when do you sell? So if you think about overseas investing is slightly harder than local because you have to worry about the currency. I'm going to buy Woolly shares today. I'll sell them in 10 years' time. I'll make the difference and I'm fine. You've got to add the two versions of currency conversion, converting it now to the US, and then in the future, converting it back from US dollars to Australian dollars. My view on US investing is this. Whatever your time horizon is on Australian shares, hopefully it's at least 5 years. It should be. Please make sure it's at least 5 years. Add 3 or 4 years for US shares. Because you want to, frankly, buy them at the right time. But then when you sell them, you don't want to be forced into selling at a price you don't want, which is why you have a long-term horizon, or at an exchange rate you don't want. And you may find those two at different times. You might get a great price for your NVIDIA shares in 5 years, but the dollar might be really, really high, really, really low. And so you've got to kind of allow for that double timing. You have to sit in cash for a while and then transfer it at an appropriate point. That being said, don't let tax drive your investment decisions. If you find the next Amazon, I own shares, NVIDIA, Facebook, whatever. Berkshire, I own Berkshire, great example, right? If I'd worried about buying Berkshire shares in 1995, I didn't own them then, but unfortunately, because the dollar was something 68 or 62 or 71 or 84 or whatever, and Berkshire went on to deliver stonking gains over 30 years, and I went, oh man, the currency difference, yeah, it might have hurt. I might have lost 10% on the way back, for example. That's a lot, right? But if I'd gained 100% in the meantime, then it's worth getting the share market return and copying a little bit of currency loss, or as I said before, sell when you want to, and then wait for the right currency opportunity, and then sell back. For example, like right now, it's pretty low. I wouldn't say the dollar can't go lower, by the way. It's been as low as 48 cents during COVID, I think. It was up $1.10, distant-ish past now, but it fluctuates a lot. So yeah, you need to be prepared for that fluctuation. I personally would let it put you off investing in US stocks. I'm not. I said half my portfolio in the US. I'm very happy with it. Coal stocks I'll talk about in a minute. AUD, we've done that. All right, 25 minutes to go, team. Any questions, throw them at me. Back up to the top. Lithium producers. Yeah, you're right, mate. Every time some analyst dies a price forecast, or does a price forecast, Pilbara bounces up or down depending on the forecast. Yeah, you're right. Not only that, it's the actual received price as well. I don't love lithium producers. Supply and demand. Okay, demand side easy. I think we'll have more EVs. I think we'll have more home batteries. I think we'll have more grid batteries. Demand for lithium is not going anywhere in my view. With an asterisk, I'm no chemist, right? If battery chemistry moves on, it might. If you bought nickel and cadmium based on NiCad batteries back in the day, you're probably pretty disappointed. Well, they're making some still, but the growth was in lithium, right? So I don't know if it's going to be the case. So be careful with that. You're relying on one specific battery chemistry, and a range of them. I get it, but roughly that's the case. Just be careful with that. Other than that, demand side is pretty strong. The supply side's the issue. Why is the price falling? Because there's a whole lot more supply come on stream. When demand outstrips supply, price goes up. When supply outstrips demand, price comes down. That's all you need to think about when it comes to commodities in general, lithium in particular. People got way too excited and forgot the, frankly, just straight up dynamics of any supply demand industry, particularly one where you can replace if more demand for Coke goes up, yes, I can make Scott's Cola, but Coke's probably still got the corner of the market. If I demand more cola in general, I don't care what brand it is, then cheapest cola wins. So lithium wise, just be careful on that one. What do I think about? I wouldn't buy lithium producers right now. Not because I wouldn't. I'm not saying I would short them. I think they're going to go down. I think it's unpredictable and probably unknowable. So it's probably a speculation at best. Again, not because the demand side is necessarily wrong, although there is that asterisk, but more because we don't know what the supply response is going to be. And if the supply response is huge, I wrote an article actually quite presciently. Thankfully, I'm not a forecaster, but I wrote an article. 4 or 5 years ago now. And I looked at the price of oil. It's very rough back of envelope calculations. Through the 20th century, I think it was, 100 odd years, might have been 1920, 2020. I can't remember exactly what it was. The price of oil went up. How much do you reckon? So we used whale oil in the early 1900s. Now we use millions of barrels of oil a day. How much do you reckon the price went up over that time? Now, it did go up. That's not a trick question. It did go up, but only 2.5 times over that century-ish of period. I have to look at the actual data. I don't remember the exact time period. 2.5 times, despite the fact that the volume of it skyrocketed. Why? Because we found better ways of drilling, finding the oil, adding to the supply, keeping the price down, all that stuff. And that, by the way, is including OPEC, who restricts supply artificially. And the price still only up 2.5 times, adjusted for inflation, obviously. So keep that in mind with lithium. If you're 1925, you'd said, man, I can see the future perfectly. In 100 years' time, we're going to be using X millions of barrels of oil a day. Okay, well, obviously I should buy oil. It's going to go up, now to go up a bit, as I said, but 2.5 times over a century. The stock market was up, I don't know, thousands times over a century, right? So just be careful with commodities. I don't know what's going to happen with lithium price. Soul Pattinson and Brickworks. You're going to get 0.82 Brickworks shares. Sorry, 0.82 Soul Pattinson shares for every Brickworks share you hold. If it goes, our way to go ahead, by the way, it's going to be passed by shareholders, and the ATO has got to give it a favourable ruling. Those things are likely, but I just want to be clear with you that you shouldn't assume. I don't know what happens with the balance, mate. Honestly, I don't know. I haven't seen the paperwork. I wish I knew. I don't know. They'll tell us in due course. I suspect it might be a cash refund, but I don't know. I'm not sure. The other thing, though, by the way, Martin, is there'll be booklets sent out dealing with all that stuff, so it'll tell you in time. Don't worry too much about it. The balance of shares we're talking about, because they aggregate, right? So if there was 0.82 and you had 10 shares, 8.2 shares out of 20 shares, the amount you lose depending on how many you carry, we're talking about a fraction of a single share. Not that there's nothing, but it's probably the realm of $15-$20 in total, not per share, just in total, I would suspect. But again, I'll have a look at that when we get closer. Check out the booklet. We'll have one of these, I'm sure, between now and then. So if the booklet's out, you still don't know the answer, I'm happy to answer that on then. Where do we go to next? Lynas Rare Earths, Nicole. That is fascinating, right? Speaking of trade wars, we know China has most of the world's rare earths. They're not rare, by the way. They used to call mineral sands, but rare earth sounds cool. You're betting on the geopolitics, and I don't have a strong view on that bet. If you had a macro view which said the Yanks hate the Chinese, they'll want our rare earths, we can do a deal with them, Linus has got a pretty good access to rare earths outside China. They're in the box seat. I think that's not a terrible bet, but it's a bet. That's the point I want to make, right? Investing is a probability-based assessment. So betting is kind of the same. The question is, how strongly is that probability calculation? How good is it? How likely are you to be right? I don't know the answer to that. I really don't. I suspect it's a tariff thing rather than a blocking thing altogether. Why? Because China needs the business and the US wants the business. If it all goes to hell in a handbasket, Linus in the box seat. But also remember, so here's the other thing about share prices. You've got to remember, if you want to beat the market, you have to have what they call a variant perception. And this is important across any company. What does that mean? It means if the market already assumes Linus is going to do well, then it's already priced that way. So there's no upside in you saying, I think Linus will do well, because the market already thinks that. You need to find something you know or you think doesn't think. And then when the market realizes you're right, that's when the share price gains. Now, you've got to be right. Is everybody already on the Linus trade? Possibly, yeah. So even if the company did well from here, would the share price do well? Maybe. But I'm already priced in. In other words, the market might already be assuming that's going to be good. And if they are, and it doesn't happen, you actually see the share price fall because that's already being assumed. A great example, the easiest example is a merger or takeover. If I make a takeover for another company, their shares go up. Now, if the merger goes ahead, the price is already at the high price. If I don't, the share price falls back. So there's not often a lot of upside from the merger announcement. Say, they're going to merge, I'll buy those shares because the market's already pricing in the chance of that merger going ahead. So that's hopefully helpful, Nicole. Dominoes from David and somebody else. I will get to that person. I'll say apologies for forgetting. When you're an investor, when you're an analyst, at some point you have to accept that reality beats your assessment or your analysis, right? I recommended Challenger Life to our members years ago. And the idea was boomers retiring, they provide an annuity product. So you take your portfolio, your super, and they buy it off you and give you a lump sum back, or you sell to them with a lump sum back. Basically like a reverse insurance policy, right? You give them all the money and they give you some back every year. The bet is that you'll outlive it, or at least you'll have a set income. You don't have to worry about the fluctuations of the market. I don't like them as investment products. I think they are, Challenger makes the money, right? So I wouldn't do it that way, but some do because they just don't want the fluctuations. They want the certainty, and I get it. And that was my view. It was like, hey, a whole lot of people retiring with a whole lot of money, and the market's volatile. Annuities aren't volatile. Financial planners love them. These guys are in the box seat. I thought it was a pretty good thesis. I still think it was a good thesis, except it was dead wrong, at least in terms of the way the company then managed to execute against my expectations. There wasn't enough growth left. I got that one wrong. That's a big preamble to David. I think Domino's is an excellent business. I think it is I own shares, by the way. It's very well positioned. The economics are very good. It's getting really good growth here in Australia and New Zealand. There's every reason it should continue to succeed. It keeps falling over its own feet. It was Europe, then it was Asia. It's kind of Europe again now. New CEO, replacing the Australian CEO. Lots going on. Fundamentally, though, if you break it all down, say, do I want a fast delivery? Pizza made to be delivered. They stay hot. The more stores they build, the closer they are to your house, the more likely you are to get it hot, the more likely you are to order from it. So it's a nice self-fulfilling kind of, self-reinforcing loop. Great economics because the stores are tiny because you only need an oven and some delivery space, and you can then send your product out. Really a great model. Really great model. So I like Domino's a lot. I own it. We've recommended it. I think it's a business that should continue to do well if you're going to stop making those unforced errors. At some point, you have to say, for all the analysis and all the thesis in the world, you're just wrong because the reality hasn't met up with your expectations. So that could be the case. That's why I mentioned the Challenger example. I think Domino's has still got lots of potential from here. So I own it. I've recommended it. Still a buy for us for what it's worth. I'm not supposed to give out that much stuff, but here you go. It's a free buy recommendation if you don't own Domino's already. I like it, and that's why I like it. What do we got? 16 minutes left. We're pretty good. Andrew, we talked about John. Rio and BHP. 50% tariffs impacting materially share price wise. It's a great question, John. So the tariff is on steel and aluminium, not iron ore and alumina. So not directly, obviously, but you're right. A lot of Chinese buy a lot of iron ore to make a lot of steel. The US is a major export market for them, not necessarily of steel products, but sometimes, but just largely in terms of their overall economy. If their economy shrinks because the US tariffs are in place, maybe they buy less iron ore, make less steel domestically, possibly. That's the real risk. And it's a risk for BHP, Rio, Fortescue. I own Fortescue shares. And it's a risk for the Australian federal government budget, by the way. So yes, it's a risk, 100% risk. Is it a massive risk? I suspect if US demand for Chinese products falls, the Chinese will probably stimulate their own economy to get through it. And if they do that, they'll probably do it with infrastructure building. So I wouldn't buy it as an offensive response to the tariffs, but I suspect the Chinese might do it. Now, would I make a bet on that? No, absolutely not. But also, I'd look straight through it. If it is an issue in the short term, maybe. Over the long term, does BHP sell a truckload of iron ore to China? Yeah, probably. Does it impact the price? Yeah, that's the other problem. We don't yet know. It's more than the share prices, the price of iron ore itself. That's always the leading indicator for the share price. Problem for me is I bought Fortescue because I thought it was a low-cost producer. I like what Twiggy was doing with some of the other stuff, the renewables and green stuff. Probably not going to happen, actually, at least in the size and scale I thought. So I probably need to revisit that thesis. But the iron ore price was also really low when I bought it. So it's kind of like really low resource price, some optionality on the other stuff he was doing with some of the green steel, green hydrogen stuff. And if the price of the iron went up, then I'd do okay. It did, and then it fell back again because I shouldn't be buying resources stocks. So that's my response there. Hope it's useful. Okay, what's your thoughts? People say leverage property and stocks. You don't leverage. What gives better returns? People say you have 100,000 for. Yeah, okay, cool. So I think you're basically saying to make using margin with shares, Jake. Oh man. Okay, it's 14 minutes. I'll try and keep moving, team. The benefit of leveraging on property is a couple of things. Firstly, the bank will lend you more against your property than against your shares. Secondly, the bank won't issue you with a margin call on your property. They will do it on shares. Thirdly, because shares are more volatile, people tend to freak out and sell when the shares are down, locking in a loss and potentially wiping out all their equity and having still debt left over. So margin for debt for shares is really, really dangerous. Now, like anything, can it be used well? Yes. Plenty of people saying right now, yelling at the YouTube machine, saying, of course it can be used well. I do it and I do it. No, yes, possibly, right? The thing is, I use the example all the time. 90% of us say we're above average drivers, right? What does that mean? It means that we all think we'll use the debt responsibly, but the people who say they think they will, maybe most will. Most, a minority won't and get wiped out. Worse than wiped out, may end up owing money, having the shares worth nothing and still having a debt. So I really don't like debt for shares for that reason. If I could hypothetically borrow $1 million at a really low interest rate with no margin calls, in other words, the bank could never say, hey, here's a margin call is. You borrow $100 to buy $200 worth of shares. Pick your numbers, right? The shares fall to 150. The bank says, well, you've got to now pay back $25 worth of that loan to get your loan to valuation ratio back to the same level. Now, maybe you've got the money, maybe you haven't. If you haven't got it, what happens? Well, they make you sell your shares at that low price. And that's why you're locking in a loss. You buy them 100, you sell them at 75, you lost $25 and you still got the same size debt because that doesn't go down, but the share value does. So it magnifies your gains and your losses. So if I could borrow $1 million tomorrow at 4% with no money, would I do it? Yes, absolutely. But I know myself. I know that I didn't sell a single share during COVID. I bought them, right? I know that about me. Not everyone's in the same boat, which is not to say I'm better than you or anybody else, just that I know myself. I've been doing this for long enough. I've got the temperament to do it. I hate the idea that someone takes on debt, gets themselves into trouble, knowingly or unknowingly, ends up doing some bad things, some silly things, some ill-conceived things, and makes themselves worse off than they haven't done it at all. Compounding in shares has been about 9% a year for over 100 years. If you can save hard enough and add enough money regularly to your portfolio, you don't need the risk of debt. Can you do it? Yes. Do I recommend it? Absolutely not, because I don't know who you are and whether you're going to do it. And before you say I'm one of the ones who will do it well, not about you personally, for any of you, I'm the one who will do it well. Remember, 90% of us think we're above average drivers. So we all think we're the good ones. By definition, roughly half of us are wrong. So just be really, really careful with that. AI, David, thank you. Sometime later this decade, job loss to AI is likely to permanently outpace new job creation. And once that tips, it doesn't reverse. Productivity should increase, but people will be unemployed. Thoughts? Man, that is the question of our age, David. I'm cautiously optimistic. In the 1800s, when the spinning jenny arrived and helped people sew, weave without just using hands, and then there was a machine for it, it was going to put all the weavers out of business. When the first dump jump plow arrived on a farm, it didn't have to be done by hand. When the first tractor arrived, didn't need the horses and the carts and as many people, etc., etc., etc. The economy has always found a way, and I say the economy deliberately, society, but the economy has always found a way to replace work with automation, which improves productivity, and it created other jobs for more people to go into. Now, you're saying right now, David, but this time it's different, and it might be. So John Templeton did say, though, it's investing, not life. The four most dangerous words in investing are, this time it's different. It really is. So I'm cautiously optimistic. I'm not bullish. I'm not super optimistic there'll be no problems. I think your concerns are absolutely valid. I think we should be preparing for them for sure. I've got some thoughts on that. A sovereign wealth fund, no brainer, particularly in that sort of situation. Potentially universal basic income. That's going to annoy some people. There you go. I'd trial it. I wouldn't necessarily roll it up, but I'd trial it, see what it does. Because if we have to use it, we want to have that stuff in place. There is you may well be right. I suspect that we find things to spend money on. I suspect we find things for people to work in. Think of everything that's been replaced humans. Excel spreadsheets replaced literal physical piece of paper spreadsheets, right? They should rule up lines and draw it all down. There was accounts clerks with green eyeshades doing that. There was typists, right? Before people learned to type by themselves, computers took over. They're out of work. Washerwomen replaced by washing machines. We doubled the size of the workforce almost because women started working. We created those jobs. Effectively half the workforce was unemployed. We didn't count them because they were looking for work, and we were probably, not great. They entered the workforce. The jobs jobs market expanded. Now is AI different? Maybe yes. I get why it might be brain robots. I get all that stuff, and maybe you're right. But I wouldn't leap to that conclusion. What I do think, and kind of think what you're alluding to, is we should prepare for that possibility and structure our economy, frankly, our personal lives as well. For those who listen to the Motley for Money podcast, we've got Andrew and I talk about that on the podcast in an episode coming up. But yeah, I am cautiously optimistic, but acknowledge this is potentially, it is literally different this time. But they probably said that about tractors. They probably said that about computers. They probably said that about photocopiers. They probably said that about cars. Everything's been replaced. Elevators that didn't need a man there to push the buttons. You actually press the thing yourself. I think about all that stuff. I think about all of the jobs that were lost. I would suspect, well, if you go back far enough, 95% of us are in agriculture, right? And yet we've created an entire manufacturing and service economy. At some point, a lot of us are in manufacturing. We've created an entire service economy. I find it hard to believe that this is the bit we fall over our feet and don't keep up. But you may well be right, David. 8 minutes. How am I going? Treasury Wine Estates, Martin. Man, yeah. I like Treasury a lot. I own shares as well. $8 is super cheap for that. I'm not a recommendation. Don't go and buy it because I said so. But I like Treasury Wine Estates a lot. I think they're a good business. Penfolds a cash cow. The value's being hidden by the other stuff that's not as good, frankly. Some of the they call it mastige or mass prestige, which is basically a word for not the really, really cheap stuff, but pretty cheap. It's fine wine, but you don't make any margin on it because the market is absolutely flooded with Australian wine in particular. But I like Treasury. I think the Penfolds business has got legs. I think China's growth returns and continues. I think once they get back into that, I think we'll see better time ahead for Treasury's profit. Tesla stock, Hugh. Oh, man, I don't know, mate. I find Tesla really difficult. I suspect in the past it's been overhyped by some people because it was winning the electric vehicle war. What you've always got to remember is that other competitors always turn up, and BYD is taking massive chunks out of Tesla in Australia, for example. Will it forever? I don't know. But is Tesla going to be the only one? No. It was supposed to be the leader, so it was supposed to have this unimpeachable lead. The full self-driving stuff was supposed to be all these miles they'd racked up. They were going to be fantastic and wonderful and never suffer again, all that kind of stuff. Maybe, but it seems like that wasn't the determining point. Now, Tesla margins are currently really, really good. But can they grow with that much competition and keep those margins that high and justify the current share price? That I'm not sure about. Cheaper after last night's fall. I suspect Tesla might be the electric vehicles BMW to someone else's Holden at some point. Is that enough, given the margins, given the expectations, given the price of the shares? Some of our team owns Tesla shares. I don't. So I don't. I would. That's my view. But I always want to be really, really clear. I hope I'm an expert. I have a crystal ball. It doesn't. It's not a perfect foresight thing. Others in my team fundamentally disagree. They own the shares. They believe they're going to go higher. I'm not saying they won't. Here's the easiest answer to your question. Warren Buffett famously has a really big too hard pile. For me, Tesla the too hard pile because I don't know. I don't know with enough confidence. I've only got a certain amount of money. I can buy one share of everything, but not probably a good idea. If I buy my best 10, 15, 20, 25 ideas, is Tesla one of them? No, just because I don't know. Not because I'm not shorting it, by the way. I just don't know. Drone Shield's fascinating, Matthew. I'm not a fan because of the uncertainty, a bit like Tesla. Does Drone Shield have the right, best, consistently good, gameable technology? Is it going to be the winner eventually? Don't know. Do you want to bet on it? No, not me. Maybe it is. Again, I will be wrong on at least some of these. I'm talking. Maybe Treasury sucks. Maybe Drone Shield's great. I don't know. But you're asking me, if I look into the future in 5-10 years and say, is Drone Shield bigger, more profitable? I don't know. Maybe if they become the standard for military and airports around the world, yes, absolutely. If someone else comes up with a better mousetrap tomorrow, if you can't compete, it's an also ran. So it's a really, really, really massive range of outcomes. And in that case, unless you're being offered a really, really good price, the chance of downside is too big for me. Grandpa Barbecue and Hal are having a chat. Good on you. I assume you know each other, guys. That's awesome. I'll need a late note. Yes, you will need a late note, Hal. You are late. You can rewatch it, though. Once this is finished, you can watch it back. Even though there's 250 people watching, that's kind of cool. I can't see it on my screen here, actually. I've got the end stream button. I have a view account, 240. That's pretty cool. Thank you, everyone, for tuning in. That's unreal. Virgin IPO, I wouldn't touch Astro Cream. Airlines are terrible businesses. At the moment, they're not. Right, so here's the challenge. How many airlines have gone broke in Australia? I tried to do the numbers this morning. Ansett, Compass Mark 1, 2, and 3, Ozjet, what's up, Bonza? Rex. I forgot about Rex. Is that 7, 8? Airlines are really tough businesses. While ever Qantas and Virgin are being really, really hyper rational, not adding capacity, when there's an excess of demand versus supply, we talk about that with commodities. If they constrict supply, now there's no cartel or illegal behavior, but if they both just rationally say, I'm not putting more seats on, and they go, I'm not putting more seats on, but there's more of us want to fly than they have seats, the prices stay high, they make a lot of money. There's an artificial constraint, by the way, landing slots and government regulation, stopping other competitors. So you ask yourself whether the market's working. If they remain hyper rational forever, then Virgin's IPO will probably be okay. I don't think it'll be spectacular, but probably okay. And when I say, I don't mean the IPO is in a day later or 2 days later or a week later. I'm talking long term. I'm a long term investor, right? Remember that? Airlines are terrible businesses. They suck. They're hugely capital intensive, generally very price competitive if the competition is allowed to work. If you wanted to bet that the government will always restrict slots and availability, and you want to bet that both airlines will keep discipline on capacity, I think there's one to change, by the way. Add a couple of flights, and all of a sudden they're both doing it, and prices come down and down and down, and we all win as travelers, not as shareholders. Because Virgin could go well in those circumstances, but those things have to remain true. It's not about the fundamentals of the business. It's about the lack of competition. If you believe that's going to remain the case, I guess you can go for it. But there's nothing inherent about the Virgin business model that protects it from competition. They're reliant on governments doing exactly that, and airports hoarding or other airlines hoarding landing slots. Virgin IPO, European equities ETF. Wow, that's fascinating, Steve or Richo. Sorry. Do I see growth? I don't have a view on EU equities. I own a global ETF which has exposure to Europe. Do I think on balance Europe's likely to outgrow the US? No. Is likely to outgrow Australia? I don't know. Do you want it for diversification? Maybe. So again, I have it's a Vanguard Global International Shares ETF. Ed Vesely talked about it on this channel. Go and have a look at that one if you want to know more about that, because we did a video on it. I think it's there now. If it's not there, it's there now. So I like it for passive diversification. I wouldn't actively choose EU over anything else. So if you want some of everything to be diversified, go for it. Personally, I'm not choosing the EU as a place to invest. I don't think it's terrible. I just don't have a kind of confidence that it's good. So I'm not for currency risk. I'll take the US. I think for all the challenges of the US we talked about at the beginning of the hour, I think in 20 years' time the US is fantastically bigger because they've got some wonderful businesses. Who's going to invent the future? Probably the tech giants. Where are they listed? Nasdaq and the S&P 500, the New York Stock Exchange. Yeah, I think so. So again, by the way, I also expect the next 20 years, 1 or 2 of the top 10 companies in the world probably are based in China and or India. So I'm not saying that's a bad only the US, but if I'm thinking probabilistically, I'm investing in the US and Australia, or globally, but globally passively, just taking the market averages rather than trying to pick it directly. Wakas Mib, is that how I pronounce that? Apologies if I got that wrong. On the US, do I recommend buying shares in other countries, Brazil and China? No. I do own Mercado Libre shares. They listed in the US. Here's the thing, and they work in South America. Here's the thing: if you buy the domicile of the company, where the company where it lists is one thing, where it does business is something very different. Think about Coca-Cola. I suspect most of its sales are outside the US these days. So if I buy Coke shares, I own them. If I buy them or I hold a US ETF or something, I'm getting international sales and profit exposure, but I'm doing it on a company listed on the US Stock Exchange. Why? I know the language. I know the regulations reasonably well. I know it's very well regulated, generally speaking. The currency is relatively stable. Do I want to invest in Brazil instead? I don't. Do I want exposure to Brazilian customers? Absolutely. I love Mercado Libre for that. Mercado Libre is, by the way, a combination of Amazon and PayPal. I own both those shares too, actually. Sorry. I'm not meaning to mention all the stuff I own, just I have to disclose when I do. Yeah, if it's for Latin America. So really cool business. I like it a lot. Thanks, Matthew, for watching. Got to run. Why do people invest? The thrill of winning because they're actually trying to get rich off their stocks. What are the reasons? That's a really good question. You know what? Why do they invest to get rich? Why do they trade for the thrill? Investing and trading feel like the same thing? They're not. Trading is trying to basically guess where a share price is going in the short term. Investing is relying on a business and paying a decent price. Difference, if Woolies going to be up 10 cents tomorrow, I buy it today. I sell tomorrow. If it's going to be down 10 cents tomorrow, I sell today and buy tomorrow. If I'm investing in Woolies, I'm thinking they're going to sell more groceries to more people through more stores in 10 years' time, and they're going to make more profit doing it. That's the investing bit. Most of the noise on a day-to-day basis is traders. So to your point, when we talk about the market every night, market's up X%. Is it saying, I'm going to buy a little bit more Woolies for the 10-year view? Yeah, a little bit. Is other people going, buy, sell, buy, sell, buy, sell, buy, sell? It's that. It's the adrenaline. I'm going to be horribly sexist against my own gender here. What's why most traders are blokes, right? It's the combination of adrenaline and testosterone. we just want to go and do it. And some do it okay. Very, very few do it well. Investing is just, buying part of a business and letting it do its thing. I have occasionally on Twitter an investor 5-day challenge where I basically say, don't check your portfolio for 5 days. Some people get through it, most people don't. It's addictive, right? It's the dopamine hits. So that's the noise. That's the sideshow of investing or of trading. Investing is just, imagine you buy a share in the local cafe. Now you might ask the cafe owner every day for the sales numbers. Maybe you probably don't. Maybe you do. You certainly don't say to a business broker every day at 5 o'clock, hey, what's it worth today? What's it worth today? What's it worth today? So yeah, try and keep that in mind if you can. But yeah, the percentage of daily trades, very, very high, speculated. Thrill of the win, trading, hyper trading, day trading, all that kind of rubbish. Long term, hopefully, it's about the investing bit is about the getting rich thing with any luck. Tesla cabs and robots are worth more than the EV. Yeah, you might be right, Matthew. Self-driving is going to be fascinating to see kind of play out. The question really is whether that's Tesla uniquely, though. Talk about AI. I mean, how much computational advantage does AI kind of level the playing field with? I don't know, but Tesla needed thousands, millions of miles of driving to get it right. Can that be done in thousands or tens of thousands of miles in a AI world? I don't know. I wouldn't bet on Tesla for that basis, but you could be exactly right. Eagers versus Peter Warren. Peter, that's a great question. I haven't looked at Peter Warren closely, but I like Eagers a lot. I like the business. I like its success. I like Nick Politis. Full disclosure, I'm a Roosters. Full disclosure, so I'm an Eastern Suburbs Roosters fan. So he's still in for the Chooks fans out there. Nick Politis is a very, very savvy businessman. Really good. Has done a fantastic job with Eagers. I like that a lot. I don't know enough about Peter Warren to compare them. Maybe by definition, I like Eagers. I don't know anything about Peter Warren, but it could be a better business. I may just not know it. I haven't spent a lot of time looking at Peter Warren, I have to say. David, I own a car company, robotics and AI. Yeah, possibly, mate. Yeah, the understand and measure bit is the problem, right? And who knows what? Here's the other thing: isn't everyone an AI company eventually? And where does that stop? Where does it start? And what advantage gets retained? I got to say that the faster technology moves, the more careful you've got to be, because which AI company comes and revolutionizes everything. Think about NVIDIA coming from the ashes, and all of a sudden now it's one of, if not the world's most valuable company. I prefer companies that do a thing that is like, let's say, be disrupted. I like brands, I like contracts, I like competitive advantages in all their sorts. So our competitive advantage, maybe if you get there first, probably is for someone. Can you work out right now how big and who and when and why and all that sort of stuff? It's very, very hard. Would I invest in Vanguard ETF? If so, VAS or other? Alan, I love ETFs. I love Vanguard ETFs. Why do I love Vanguard? They're no better or worse necessarily than other providers. Sorry to the other providers if they're watching. What I like about Vanguard is they're a not-for-profit company. What does that mean? Well, in and of itself, nothing. But if you're investing in an ETF, hopefully it's long-term, hopefully like decades, right? Because you don't have to sell and buy another ETF because you'll pay capital gains. So if you're putting your foot on an ETF saying, I'm going to invest in this ETF that covers the Australian market for the next 40 years, hopefully, who's more likely to have the lowest fee? Now, I don't know. But if you ask me to handicap the odds, if Vanguard doesn't have to pay a profit margin, and it's massive, is it going to be as good or better than the others? Possibly, probably. If it's going to be worse, not by much. So it feels like a good bet. If I'm investing in a for-profit provider, they're going to want to make a margin. Maybe they can, maybe they can't. But yeah, I just think, again, probabilistically, go with an not-for-profit guy because they're less likely to. By the way, same with super funds. The not-for-profit funds outperform the for-profit funds. Why? Because you've got to pay the margin with the for-profit funds. Just the reality of it. Sezzle stock, any view, Nikhil? Nikhil, I hope I pronounced it correctly. No view. I worry that at some point their product becomes someone else's feature. PayPal already offer it. Some banks already offer it. What's Sezzle got left after that? Do you use Sezzle or just use your own bank? So there's a burning platform there a little bit. Maybe it doesn't happen. Maybe they always maintain it and keep a separate business. I mean, these are persistent despite the fact that other banks have their own payment methods. But I don't think you need Sezzle if your own bank does it. And if the bank never does, or Apple or Google or PayPal own PayPal shares. So if it does at some point, I don't know. It may never happen. But if it does, it's kind of existential risk for Sezzle. So just don't pay too much. Long-term outlook for Rio. Don't have one. I would buy a resources a miner when the commodity price and the share price were low, relative to their historical norms. And I would sell if I was going to when they got high relative to their historical norms. No guarantee. Best way to put yourself in the best place. By definition, the long-term outlook means what's the long-term outlook for iron ore? I have no idea. How much iron ore is mined next year, 10 years, and 15 years? Don't know. If someone comes on stream with a big mine and pushes the price down permanently, you're in trouble. If mine's closed, no one opens a new one for lower, then Rio's sweet. I don't know what the future is on that one. We're way over time, guys. Sorry. Showing my colours. Eagers is a great model, have a lot of property as well. Yes. No negatives, they're a monopoly for the consumer, so maybe paying overs for vehicles and service. Yeah, possibly. I don't think they're a monopoly. They're probably local monopolies, but all car dealers kind of are. They're getting up towards there, though. Yeah, they're taking up more and more market share. The other risk for Eagers, by the way, is showrooms like Tesla or BYD, where the sales get done effectively online or effectively equivalent to online. You don't have the big car yards, and you don't need the stock of the salespeople. So that's a possible. I think it's likely, but it's possible. CBA and what to do, Mark. Thank you, mate. You did ask. It's too expensive for me. I would sell them if I own them. How's that for honesty? The P is ridiculous for the value, for the growth. The only way the current share price is maintained is if everybody keeps believing. So you've gone from betting on the business to betting on others who are betting on the business. I don't know what very quickly. I just forget we'll do this live. I got to stop, guys. I apologize because I don't want to drag people over time. Thanks for hanging in there, though. P of 32 times earnings. 32. Google is a P of at 18, I think. You're paying 75% more, 80% more for CBA with modest, if any, growth versus Google or Apple's PE is right now. Again, you choose your own businesses. Apple stock, 31 times. There you go. As much for Apple as for CBA. What's got the better growth profile prospects? I don't know. Maybe. If I was going to buy a bank, I'd buy one of the others. I don't think you should pay 32 times for CBA. Personally, not can't tell you what you should do, Mark. Paul, better way to dollar cost average given the Australian broker. Given the relative high price of US stocks. Most brokers let you buy fractional US stocks because it operates a bit differently. So you can buy half a Berkshire stock. I own shares. Half a Disney. I own them. Half a Facebook. I own them. So you can buy fractional shares every month. Depends what else you're buying. Depends how much other money you've got. The more frequently you do it, the better for dollar cost averaging purposes. Just keeps the discipline in there. So do it if you don't have to pay too much in brokerage. In terms of the price for the shares, though, if your broker offers fractional shares, ask them. They'll tell you. Then you say, I buy $200 worth of Facebook, not a one share for whatever the price is. And they'll buy you 1.4 shares or 0.8 shares or whatever the number ends up being. So you can do it that way instead. Okay, we got there. Ben and Hannah Smith, views on crypto. I don't have any. I'm not anti-crypto. I'm not pro-crypto. You're with crypto, you're relying on others wanting it in the future. Do I know people are going to want more Bitcoin in the future? I have no idea. I would probably, from all Andrew Page, who I do the podcast with, loves Bitcoin. He tells me that Bitcoin's the only crypto. He doesn't even want to call it crypto because he reckons it gives too much credit to the other guys. On his say so, not that he's giving advice, but given his views, I think I would, if I was going to do crypto, I'd go Bitcoin. It's the biggest, most widely accepted, most distributed, least messed around with, etc., etc. Makes perfect sense to me that Bitcoin would be the primary one. That being said, doesn't mean that XRP can't go up in price. So again, you're talking about, can it go up if the market loves it and falls in love with it? Yeah. Is it likely to? Don't know. All right. 196 of you hung around for an hour and 9 minutes and 20 seconds. Thank you very much for joining me for Motley Fool Live on YouTube. I hope it's been fun. I've enjoyed it. I love chatting about this stuff. I love interacting with you. So thank you for making the time. I know Friday afternoons aren't always the best time. If you like this and want more of it, please, please, please check it out. Please also do me a favor. Can you like the video and subscribe to the channel if you like this stuff? We do Stocks in Focus, Stock of the Month, what I've been reading, these videos. Adam Surplus, my boss, and I do Motley Full TV once a month. Really great stuff. So like the video if you wouldn't mind. It'll help other people find it, make me feel good. But also subscribe to the channel, hit the notification bell as well. I know everyone on YouTube says that. If you don't want to hear more from me, don't subscribe. If you want more of this a little bit at some other point, if I've kept your attention for an hour, hopefully I've done something right. Whether you're watching live or after the fact, thanks for tuning in. Have a wonderful Friday afternoon. Have a great weekend. Have a good long weekend if you're in one of those states that's celebrating a 3-day weekend this weekend. And until we speak again, as we always say at the Motley Full on. See ya.